The once steady cadence of neon signs flickering on at dusk, fryers hissing in unison, and drive-through headsets crackling with late-night orders is growing noticeably quieter. 5 brands that long ago graduated from regional curiosities to national fixtures: Burger King, Jack in the Box, Checkers, Rally's, Crystal, and even portions of the vast McDonald's network, have entered 2025 looking less like permanent parts of the roadside landscape and more like endangered species. Financial disclosures, franchise owner lawsuits, analyst briefings, municipal license cancellations, commercial real estate vacancy lists, and a rising chorus of dissatisfied customers together outline a story both familiar and unprecedented. The fast food middle tier is buckling under inflation, debt, store cannibalization, and a consumer who now regards digital convenience, menu novelty, and perceived ethics as non-negotiable. Jack in the Box sits foremost among the wobblers, built on an anything-goes menu that crams tacos, egg rolls, croissant sandwiches, and bacon-stacked burgers into a single 24-hour line. The chain is discovering that culinary chaos is expensive when every ingredient, from avocado pulp to fryer, shortening, costs 25–40% more than it did in 2020. Corporate tried to offset that complexity with a ghost kitchen push, spinning up digital-only chicken wing and melt brands. Third-party couriers, however, reported out-of-stock snafus topping 18% and average ticket wait times north of 50 minutes, clogging already tight back-of-house footprints. On the ground, operators complain of royalty and advertising, fees that near 10% of gross sales while traffic shrivels. A 2023 franchisee suit in California alleged systemic indifference to unit-level economics, and by the fourth quarter of 2024, roughly a ninth of the fleet had quietly disappeared from the corporate location finder. Management's latest turnaround memo promises remodels, drive-through AI, and a slimmer SKU roster, yet lenders point to net debt exceeding pre-pandemic highs and same-store sales off 8%, a slope that, if unflattened, could push the chain below critical size before the class action docket even clears. Checkers and Rally's, the drive-through double act operating under 2 names but one system, is in even tighter quarters. The concept's small boxes and paired lanes were hailed as efficiency masterstrokes a decade ago. Today, they hinder inside lane curbside pickup, complicate third-party delivery traffic flow, and cap kitchen capacity just as discount bundles balloon average ticket size. A 2024 private equity cash injection went largely to $1 limited time. Deals that lifted transactions but torched profitability, leaving many stores unable to afford mandatory equipment upgrades. Franchise turnover data compiled by trade consultants show nearly a quarter of the brand's operators have exited or defaulted on leases since mid-2022. Closure announcements cluster in the Midwest and Deep South, the very regions that once gave the chain its cultishly loyal seasoned fries following. Meanwhile, newly remodeled competitors, Wendy's Global Next Gen units, McDonald's 3.0 dual-lane reflows, serve a car in roughly half the time Checkers now logs at peak. Even the Golden Arches are discovering that ubiquity is not immunity. McDonald's retains the largest market share, the deepest digital wallet, and arguably the most sophisticated supply chain in food service, yet pockets of its U.S. empire are under direct threat. Hyper-urban restaurants beset by $20 hourly wage, floors triple-digit percent, rent escalators, and rampant late-night security costs no longer pencil out. Internal franchise bulletins obtained by investment analysts list more than 300 high-risk units slated for shutdown, relocation, or franchisor repurchase in 2025. Parallel headwinds include an activist cohort of Gen Z diners skeptical of industrial beef, second-tier cities objecting to single-use packaging, and a volatile commodities tape that forced menu prices up roughly 27% in 4 years, dulling the brand's once ironclad value perception. The experience of the future kiosk conversion, originally billed as the anti-inflation solution, has produced only mixed uplift. Some markets report higher average check, others see guests order less when they confront price matrices on a 27-inch screen. For a company that still opens one new restaurant roughly every 13 hours worldwide, the decision to retreat from select boroughs, transit hubs, and college precincts signals how brutally local cost structures now shape survival. If McDonald's can accept surgical retreat and still thrive, Crystal may not have that luxury. The Chattanooga-born slider pioneer limped through a Chapter 11 reboot in 2020 with debt north of $100 million, shaved weak stores, hired celebrity pitchmen, and even tested a robot-staffed pop-up in Atlanta. Yet labor churn persists. Crew turnover runs above 150% annually, and the 90-second griddle steam technique that made Crystal's two-bite burgers an after-bar legend is harder to execute consistently when shifts are staffed by skeleton crews. Franchisees who deferred equipment maintenance during bankruptcy now face $200,000 cook line overhauls they cannot fund via conventional lending. Reports filed with Southern County Health Departments show an uptick in temporary closures for hot holding. Violations and pest control further eroding consumer trust. As of April, at least 70 units have vanished versus pre-pandemic counts, and insiders whisper that the private investors who took control in 2021 are soliciting buyers for the intellectual property package alone, without deep-pocketed ownership, willing to deseasonalize sales. Crystal clear night owl nostalgia may evaporate before the chain marks its centennial, towering over them all in brand equity, but sinking fast in operational health is Burger King. Restaurant brands. International spent much of 2023-24 trumpeting the Reclaim the Flame Capital Plan, $400 million earmarked for Whopper marketing and digital drive-through boards, plus $250 million in co-investment remodel funds. The early read is sobering. Roughly half of U.S. franchisees are deemed financially distressed by RBI, including 2 of the top 10 multi-unit groups that filed Chapter 11. Those collapses alone put more than 400 domestic restaurants on the closure or sale list. The brand's U.S. footprint now sits near 6,600 stores, down from 7,300 a decade ago, and internal projections admit another 300 could disappear before remodel grants arrive. The consumer-side woes are equally acute. Flame broiling still resonates, but value menu math no longer beats McDonald's $1, $2, $3 tiers, and premium experiments, Ghost Pepper Whopper, Chi-King Sandwich, spiked food cost without sticking as traffic drivers. Add in the Clown King marketing whiplash, moldy Whopper authenticity, spots one quarter, anime crossovers the next, and the chain feels less rebels rule than rudderless. What unites these 5 sagging banners is not a single misstep, but a lattice of systemic challenges, higher commodity baselines, wage mandates, digital convenience arms races, ESG scrutiny, zero-interest capital gone forever, and a diner who can assemble superior cash value comparisons on a phone in under 10 seconds. Chains that once relied on novelty or sheer footprint now need bulletproof unit-level economics and cultural resonance to justify every 30-second ad buy. Many are running out of time to prove they belong on the 2026 roadside map.